Hello students. So today we're going to continue where we left off in our last class. We're going to talk about the objectives of accounting. We're going to see other aspects of this chapter. So the first that we're going to talk about is the objective of doing accounting. So what are some of the objectives? Why should we do accounting? That is our question here. So as we know, when we do accounting, we maintain a systematic record. So the first objective is to maintain a systematic record. So we maintain a systematic record of our accounts. When we say accounts, that means all the transactions, whatever our business is dealt with within this time period, we are going to write it down. So the first objective is to maintain a systematic record of our accounts. Why is it required to maintain this? Because we need to analyze this later on. We need to understand how we have done in business, and we cannot always remember things. So we maintain a systematic record of our accounts. The second is to determine our profit or the loss. In business. So we maintain a systematic record of our accounts. The second point is to determine our profit or loss in business. We need to do accounting to find out whether we are in profit or loss in the business in the next year that we are talking about. If we do not know how much profit or loss our business is earning, then how will we continue in business? We need to constantly keep inquiring about what profit we are making or what loss we are incurring. So this is the next objective. The third, it is to determine your financial position. So determining the financial position. So how do we determine our financial position? Now, this is something which we're going to learn in the later chapters, but for now, just for your information, we determine our financial position by making something which is called a balance sheet. A balance sheet. A balance sheet looks something like this. It'll have two sides. The left-hand side will be where all your liabilities are written, and on the right hand side all your assets are written. These are of the business, so all what I'm talking about is of the business. So some liabilities that we are supposed to know, we will see later. Let's talk about the assets. Assets are something which we own, which may be having a monetary value. For example, an example of an asset you can consider as furniture or a computer. So you've paid some money. In your office you have money, so you paid some money, purchased furniture for the office, purchased a computer for the office. All these are in terms of money which you paid, and later on we are going to give you a benefit. All these assets will give you a benefit. How is it that it will give you a benefit? Purchase furniture so that you can sit on that, maybe a table, a chair that you bought, and you're using that within your office to do business. You purchased a computer so that you're using that in your office to continue to do your business. So these are items which are going to increase the monetary value of your business. They're going to help you to earn money. And even if you want to sell them later on selling them, you will earn back some money. So these contain value in terms of money. So these are all our assets. Some other kinds of assets you can think of is your bank balance. Now, I'm not talking about your personal bank balance. This is the bank balance of the business. The business also maintains a bank account. So it may open an account in which it has kept some money. That is again an asset for the business. The cash balance, some money which the business keeps with itself in the office, that is the cash balance. So all these items which I've written on the right side are the assets. So at the end of the year, this point is saying we need to determine the financial position. So at the end of the year, when we are about to find out what is our profit and loss, just like we saw in the last sentence, the last point, when we are wanting to know our financial position, how do we get to know? We get to see, we get to know it through our accounting, because in our accounting, we will note down all these amounts of how much cash we have, of how much bank balance we have, of how much worth computers we have, of how much worth furniture we have. So all these are our assets. So this helps us to know our financial position. Okay. The left side of this balance sheet I'm not discussing. We'll discuss it further once we get into some more detail of this subject. All right. The next point, it facilitates the management. So the fourth point is the objective of accounting is to facilitate the management. Facilitate means to help. So how does accounting help the management? Management are the people who are running the business. Okay? So you may be an owner in the business. You may have invested all the money to start the business, but you have kept a manager. You have kept a person who is maybe at a high position in your organization to run this business. Those people are the management. So accounting is done by writing it down in the books of accounts. And how will it help the management? Because the management will refer to these transactions which you have written down in the accounts and see as to what is the requirement of the business. Is it required to invest more in research? Is it required to invest more in purchasing raw materials? Are the sales enough, or should the sales be increased? So the management is the part in the organization which is going to take all the major decisions. All the major decisions are taken by the management. So they need to know and they need to be helped out, and accounting is what helps them in taking these decisions. The next point is to provide accounting information to the users. To provide accounting information to the users. Now, who are the users? Users could be so many, and we'll talk about it in a little while. But just for the sake of telling you about this point, I'll give you an example of some users. Think of a bank. A business is continuing, but a bank comes in the picture when? A bank comes in the picture when the business wants to take a loan. So the business will approach the bank. The bank will check on how much profit this business has been making in the past. Because if it gives it a loan, it needs to know whether this business will be able to pay it back. So the information has to be provided through accounting. What this business has been doing in the past so many years has to be shown to this bank. The bank will then judge whether the loan should be granted. So the last point was to provide accounting information to the users. And among the users, I've told you the users could be a bank. Another user could be the own employees. Why will the own employees want to know about the business? It would be because they want to know whether this business is actually making profit. Nobody would want to stay in a business if there are only losses. They would want to change their job. They would want to shift to another organization. So they need to know the accounting information of this business. They need to be able to see it. So that is another objective of accounting. All right, now we come on to some functions of accounting. If we talk about functions and objectives, you can consider them to be the same. The function of accounting can also be termed as the objective of accounting. So both the topics can be understood through these points itself. So what 5 points we have written over here, these are the functions also of accounting. let's come to the advantages of accounting now instead. So why is it advantageous to do accounting? Now, some of our points will be repeated. Whatever we have done up till now, we'll come across them again. So the first thing is to provide financial information about the business. It's an advantage. When you do accounting, what is an advantage? You get to get to know the financial information about the business. So any business, all that it is dealing with in terms of finance, in terms of money, this information is communicated through accounting. So this is an advantage. If anyone wants to know how much money this business is earning, how much was the loss in the past year, everything is come to know, will be known through accounting information, through the financial information that accounting provides. The second point is it replaces memory. Accounting replaces memory. What does this mean? See, we write so many transactions. We know that we have umpteen number of transactions, n number of transactions in a business. In a month itself, for example, we have 100 transactions. What kind of transactions am I talking about? Maybe we purchase raw materials. Maybe we purchase furniture from XYZ. Maybe we've sold goods to ABC. Maybe we've sold furniture or we've sold a building which we own. All these things which are related to the business, which are of the business, we are buying and selling. So you can imagine how many transactions there are going to be. So if there are many transactions, we are not able to remember such transactions as to how much we have spent or how much we have earned on these transactions. So accounting, as we know, it is a way of writing down transactions in one place in a very systematic order. So accounting replaces memory. It replaces you remembering things. Okay, this is an important point. You can mark it here for you to keep in mind. Third point. Third point, it facilitates comparative study. So accounting facilitates comparative study. What are we talking about over here? Every year the business is functioning. So every year the profits are found out through accounting or losses are found out through accounting. So we can compare. In the first year, suppose we earned a profit of 10,000 rupees. In the second year, we earned a profit of 5,000 rupees. So we can compare the 2 years information through our accounting that we have done and see the reason for us getting less profit in the second year. Okay, so this is a reason for comparing and it facilitates this comparative study. The next, it facilitates loans. Facilitates loans means that it's easy to get a loan when we do accounting. Why? Because when we require to get a loan, say from a bank, then we need to show those people the books of accounts that we are maintaining. Whatever accounts we have maintained, it is acting as a proof. Whatever accounts we maintain, I repeat, act as proof. People believe these, whatever is written down and shown to them in writing. So accounting helps you to get a loan, maybe from a bank, maybe from a financial institution, etc. So the fourth advantage of accounting is that it facilitates loans. The fifth advantage It acts as an evidence. Accounting acts as an evidence in court. So it acts as proof. Okay. So suppose there is a case which is done on your business, and the case is about some transaction which had taken place. Now, when you have done accounting, you have the proof of how much worth was that transaction, how much in terms of money was that transaction. And for suppose a simple transaction, I give you an example of maybe you purchase raw materials. When you purchase raw materials, you have spent 10,000 rupees and you want to show the proof that you have spent 10,000 rupees for this purpose of purchasing raw materials. There are some ways in which you can prove this. One way is to show your books of accounts that this is what I've done in my business. The second is to show the bill that you must have got when you purchased this. So all these records are kept by the business. It is maintained by the business, just as accounting is kept always. In the same way, all the bills are stored and kept, and they act as proof when it's required, even in the court of law. All right. Now let's come on to some limitations of accounting. We'll get on to some limitations. Limitations mean what are the drawbacks? Accounting has some drawbacks. So let's talk about some limitations of accounting. So the first drawback of accounting is that it is not fully exact. Accounting is not fully exact. Now, what does this mean? I'll give you an example. Over here, we have something which is called closing stock. In accounting, we have one item or one term which is called closing stock. What does closing stock mean? Closing stock means the value of your stock which is left unused. Stock means the goods. So all the goods that are left unused at the end of the year. Now we have some assumptions in this accounting. It's not a fully exact way of calculating it. So what is the assumption that we take? Closing stock is valued at cost price or the market price, or the market price, whichever is lower. Okay, whichever is lower, we value closing stock at that price at the end of the year. So this is an assumption. It's not exactly what we are supposed to do, but we are assuming, we are keeping this in mind that it is going to be taken at this price. So suppose my cost price of my closing stock, whatever materials, whatever goods I am left with, its price is 10,000 rupees. And today the market price of these same goods, market price means what's the price of these goods which I'm left with in the market. Suppose the market price is 5,000. So this point says we have to value closing stock at the cost price or the market price, whichever is lower. So which of these two is lower? The 5,000 rupees that is mentioned here. So we are going to write 5,000 rupees in our books of accounts when we are closing this year. All right, so this is one limitation of accounting. The second is We have to use unrealistic information in maintaining our books of accounts. Uses unrealistic information to maintain our accounting. Now let's understand this point. Let's say I purchase a machine. I purchased a machine. This is my machine, and this has costed me 5,000 rupees. Okay. Now, once I purchase this today, I am going to show it in my books of accounts that I purchased a machine for 5,000 rupees. But say tomorrow, if I go to the same market and I find out the price of this, the price has changed, it has come down. It has come down to 3,000 rupees. This change will have no effect in accounting. If the price of this machine has reduced tomorrow in the market to 3,000, I will not rub out the amount which I've already written in my books, which I had written as 5,000. I will not rub out that amount and I will not correct it to be 3,000. So this is a drawback. We are using what? We are using the historical cost. We are using the historical cost. And what is the historical cost? The one which we have paid in the past. The one which we paid in the past was 5,000 rupees. So the point over here is that this is a drawback in accounting. The present value of the machine or the asset is not taken into consideration. The changed value is not taken into consideration. Whatever was the machine bought at, that price is going to be taken. So it's again a very unrealistic way of doing accounting. But this is followed. So this is a limitation. The third point. The third is that it ignores. Accounting ignores the qualitative aspects. Now, what are qualitative aspects? Take, for example, I am running a business in which I have 3 employees. These are my 3 employees. Now, among these, this person is the best. He works very well. This person is average. And this person is bad. Now, what is happening here is because of these 3 people working in my organization, I'm going to earn profits at the end of the year. So, some person who's working best, because of him, my business is doing well. Because of this average person, my business is running on an average way. And because of this bad person, my business is also not doing well in some way. But when I'm talking about accounting, accounting is talking about items which are in terms of money. So we are neglecting. So we are neglecting the qualitative aspect of these employees. And what is the quality? The quality of these people working in my organization is what I'm ignoring. You understanding? The quality. These among these 3 people, the first is the best, the second is an average person, third is a bad person. He's not good at his work at all. But I'm not considering this aspect when I'm doing my accounting, when I'm trying to find out my profit and loss for my business. So this becomes a drawback. Accounting ignores the qualitative aspects of a business. The next point. This is going to be a very important point now. It's called accounting may lead to window dressing. Now, what is window dressing? This is a very important point to understand and remember in market. When I say window dressing, let's understand this. We all go to showrooms. We see how a showroom looks like. From outside, it will always appear to be having very good quality of material inside. They'll have the best display. So what is it that they are doing by displaying the best from outside and showing it to you? They're trying to attract the customers. So in the same way, accounting can lead to window dressing by these accountants who are actually doing this accounting by showing the profits on a higher side. See, you can show your books of accounts, and in that, whatever you show is supposed to be authentic. But there are some people who actually, while maintaining their books of accounts, instead of say writing my sales as 10,000, they don't write it as 10. They write this as 1 lakh. Now, what will happen if my sales are more? It will show that I've sold more goods, therefore I've earned more money, therefore my profit is more. If it shows that my profit is more, my balance sheet or my books of accounts will show eventually that my business has made a profit. And this can be misleading when I want to go to a bank to get a loan. The bank will ask me for my accounts. It will show what accounts I have maintained. If I show them this, they will at first believe, but they will still check. So I take it for granted that this bank is checked and it has found out that I have altered my amounts. I have not written the correct amounts. So say I get thrown out from there. I have not been granted a loan. Now in a similar way, if suppose I go to a normal person and I show him these books of accounts, who is maybe an accountant, but he doesn't come across this, and I ask him for money as a loan, he grants me the loan. Okay. Now he's granted me the loan depending on my profit, what I've showed to him. So this can be misleading, and therefore it is called window dressing, in which you're altering your books of accounts and you're showing your profits on the higher side. Right? So this is a very important point. It's a very big disadvantage of accounting is that it could be misused and it could lead to window dressing. These are 4 points which we can remember. We'll stop here. We'll continue this again.